Good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective channel, where I help you make your dreams a reality. If you've seen any of my past videos, you understand I love strategy, and I really love targeted strategy. And the awareness is key because I'm going to keep sifting through financial memes and just general financial advice using our investment strategies along with some everyday down to earth common sense. So reminders and disclaimers. This is an unedited video. Who knows what you'll hear as I film these in my house. And honestly, I'm filming this at 10 o'clock in my house. And hopefully everybody is asleep and the cats are not running amok. On this video, I will show our strategy of using closed-end funds. And we'll explain that system because it relates to what I'm going to talk about. And just know I'm not a financial advisor. I'm a financial strategist. I don't speak like the herd. I don't talk like the herd. I walk in limited company, and I'm okay with that. So when I do this video, as well as when I do all my videos, please know that I'm not out to slander anybody. I'm invested, or I'm interested in separating the good from the bad when it comes to financial advice, because none of us want bad financial advice. So this is a pretty unscripted thing in that I have a script up to this point, and I've done I've done my homework. I've done the background on what I'm going to talk to you about. But at this point, going forward until I hit the end of my video, there is no script. So I'm going to share my screen and compare financial strategy and talk about our financial investment strategy as it comes to the stock market and closed-end funds and someone else's financial strategy. Now, I'm not saying it's a bad financial strategy. Um, it is a different strategy than mine, and I don't pay for it. So I get missives from Seeking Alpha, and I found out about them through my dashboard on Webull. We use Webull to self-manage our closed-end fund portfolio. And on my dashboard, all these different financial articles pop up about different companies. And initially, I could see some stuff that Seeking Alpha put out. But this is more of their subscriber page. And so when it pops up, it looks like this. And I'll be honest that I do pay somebody for financial advice because it trends along with my strategy, but it also, the advice that I pay for, I like their take. What I've read of Seeking Alpha, and I don't want to say that let's see how to say this. I've read some stuff from Seeking Alpha, but their strategy is different than mine. It is single stock, um, and it's when they do articles like this, it's like they're peering into the closed-end fund market space, and they're evaluating a different investment platform from a single stock perspective. So, of what you can see when you read this article title, which we really can't see anything else besides that, unless, besides this little bitty snippet from the article itself. But our strategy is closed-end funds. So when we started with closed-end funds and what we continue to do since being started with closed-end funds, I read the Contrarian Outlook, and Brett Owens and Michael Foster talk about closed-end funds, and they teach closed-end funds. And for the last 2.5, maybe like 2 3/4 years of only investing in closed-end funds and refining our methodology for picking closed-end funds, I took Michael Foster's advice about closed-end funds one step further. So closed-end funds are freely available on the market. Like pick your trading platform, you can buy them. And they're akin, I get like the easiest way to explain it is they're like mutual funds, except two key areas. Closed-end funds are closed. You cannot create new shares out of nowhere versus mutual funds, single entity stocks. They can issue new shares whenever they run out or whenever they hit a certain benchmark, they can just create new shares. And the new shares do not impact the existing share value. So if Coca-Cola is at $65 and they completely run out of shares and they issue pick a number, 10,000 new shares, those brand new shares, there we go, have no bearing on the existing price, right? They just get added to the whole. Closed-end funds are a closed system. There are limited, and if you go to CF Connect, it'll tell you how many shares there are available for each fund. But it's a closed system in that it truly works on supply and demand. So if it's limited supply, right, price is higher. If it's great supply, the price is lower. And that creates an interesting system. So you can assess the value of every fund by their net asset value. It'll tell you what a single share is worth. But interestingly enough, closed-end funds sell for discounts. So that's a percentage off. And the fees associated are factored in. So you're not paying that price and, or say, like you're not paying that price and getting that dividend and then having fees taken off. It's all factored in. So who doesn't want a discount? Who doesn't want a good deal? So if you think of break even at the dollar mark, if you buy something at a premium, like if you buy it at a 1% premium or a 10% premium, instead of paying $1, you're paying $1.10. If you buy it at a discount, we'll say a 10% discount, you're paying 90 cents instead of $1. So again, who doesn't like a good discount? So how do you separate or how do you distinguish how good the discount is? So of the 423 different closed-end funds, and we can scale these by discount. So besides the two rows at the top, there are a ton of funds in discount. So there's currently 374 funds with some type of discount. So you're not paying full price. That's amazing. But how do we distinguish how good the discount is? And 2 years ago, I've looked for the article, I haven't found it. Michael Foster was talking about when to really buy into the closed-end fund market. And you have to look for the significant differences. So you have to look at the historical data. So for this fund, HFRO, current discount is 33.5 cents. And these values are based upon my update last Saturday. So it's a little different today. So last Saturday it was 33.5% off. So if we round it down to 33, okay, which is different, but if it's 33% off, you're paying 67 cents instead of $1. So 33 is a big number, but historically the discount is near 15%. So when the current discount is double or more than the historical discount, that's a significant difference. And it registers a buy signal. But you also have to be careful for funds that actually want to close that discount because there are funds out there that always sell for a discount, right? Like you could look at a fund and be like, oh my gosh, it's got a 15% discount. That's amazing. But if you don't relate it to the historical data and see that since the fund was created, it's just been a straight 15%, it's true you're not paying full price when you buy it, but if a company wants to actually close the discount window, meaning the share price would go up, excuse me, the share price would go up, then the discount would gradually go down, right? So as when you buy it, the share price goes up. If you sell it, you get the gain. But that's still not exactly our strategy. Our strategy is pay attention to the crazy discounts, but not just the crazy discounts, right? Not just when they're double. We also want to quantify, or I mean, not quantify is the best way to put it, but so when something becomes really tempting is when the existing discount is double or more than the historical discount, but when it's also greater than the 5-year discount. Because, I mean, just gosh, the last 3 years alone in the market has been crazy, depending on what you're into. And then you look 2 years before that, you look at the housing market issue in '08. Like there are these blocks of time, right, as we go, that are unique and individual. So you want to see how a company's performing in the last five, from my standpoint, in the last 5 years. So if their current discount is double or more than the historical discount, that's the first. And if the current discount is also greater than the 5-year discount, then they get a triple asterisk. Like that's a buy alert for me. Excuse me. So the color coded in blue are what we own and what we manage in our portfolio. Green is interesting for whatever reason I track it. And purple is recommended by somebody, or at least somebody I trust. Gray is factored out based on those parameters. And then white, I mean, white's there. But every week I update the olive, the blue, and the purple. And then every month, everything gets updated. So when Seeking Alpha analyzes closed-end funds, they're not taking into account the discount or the historical discount. They're just looking at it like your standard average stock. At least that's what I can tell from reading the free articles. Since I don't read the paid articles, I can't view the paid articles. I don't exactly know the strategy they're employing inside of it. But if we look at the fund they're talking about, so if you go to CEF Connect, it's got every closed-end fund. You can look at their current history. So it's a rebranded fund. But if you're curious what it looked like before that, here's the previous history. And I see what they're talking about, like a up and down special distribution, low distribution, or low yield, or dividend, right? This up and down thing, hidden special distribution, then it kind of sloughed off, right? Picked up again, inconsistent. But since it reformed, it's been steady the last 6 months. So historically, you kind of want to know the value. But at the same time, since it reformed, you really want to know the discount the last 6 months. So of the initial data, right? Current price, current discount, current distribution, pays monthly, pays really well monthly. Okay, it's all mortgages or bonds. Okay, but as we get back to this list, so our strategy is this, and I do videos on this on the weekends. So let's go back. So I'll make a video about the sorting out funds and why and how and the methodology behind sorting them out. So this is our wealth of information. Like companies tracked the complete master list of funds, our portfolio last year, our dividend history last year, our existing portfolio. Blue is owned, gray is sold or got liquidated. All of our distributions or dividends. So you have the projected amount, what we've made when we started in 21, right? We started, so the number kind of grows. So we started in 21, we added more in 22, we've added more in 2023. We're waiting on the last month, which should be about 200-ish in dividends. That's the running total. I'm just kind of flashing through video or flashing through data just kind of so you can see what I'm doing. This is our return of investment of dividends, current dividends, current this is the current yield of our portfolio, which is crazy to most people. But this kind of sits middle range on closed-end funds. Annual dividend, current total investment, and I just like to track how many shares we own. So on the master, I sort targets. Always reverse. I sort targets. So you end up with this list of options. And then I would sort that based on yield. And I'm looking for stuff that's 9% or above. The exception is there's a municipal fund that is tax-free that sits below 9%, but pays greater than 9%. Well, it's on the last video. And then, so I'll cut this out, transfer it to a page. So everything's discounted and it's discounted better than its historical and better than its 5-year. I'll sort it by yield and then break it down from there. And based on where I see the market now, where can we find the best dividends now? And where do I see the market going 10, 20, 30, 40 years from now? Right? Our focus is not so much on stock price. When the stock market goes up and down, I mean, yeah, it sucks to see your portfolio value fluctuate, but it doesn't scare me because our portfolio is built on dividends. So whether the price is up or down, I'm just tracking discounts. And I have goals for the portfolio and I have plans going in the future for the portfolio, but I'm buying the trends in the current market, but looking 40 to 50 years ahead. And I'm building a dividend portfolio, a no withdrawal, like the principal investment stays invested and we're not going to withdraw it. Anything we sell just gets reinvested into the same portfolio. And then the goal is to live off or supplement your retirement off the dividends. So whether the market value is doing this, you're getting dividend income. So if we take the same approach and we look at this fund, CCIF, and we rank these back into, so this is that fund, which has changed a little bit since Saturday. Okay, the discount's gone down. Price has gone up, right? It has a fat yield. But is it like it's good in the sense of you're not paying full price. So instead of paying $1, you're paying about 96 per, 96 cents, 95 and a half cents. Okay, but if we look at it as a whole, this is just the existence of the fund, right? From about, say, it reformed in August. So from September on, it's been really consistent. And since its inception, it's got this crazy track record in the last 3 years. It's and it I don't know why the system doesn't look back further. Like we knew the company's been around for a lot longer period than 3 years, but it only has data for 3 years. The article doesn't necessarily say when they reshaped. So maybe they reformed 3 years ago and then they restructured their dividend policies 6 months ago. Okay, so we'll look at both options. So if we take the 3-year data, if that's accurate, they reformed 3 years ago. then we want the current discount to be double that, and it's not. Okay, so it doesn't make my list initially. And if we take the 6 months, like if we go back, so if this is significant, which right now it's like 4.95, right? So if this is significant, just like this, uh, that's a little bit different. That hadn't been around that long. See what we can find at the top. That one's crazy. We want the existing discount to be double the historical discount, at least. So if that's the 3-year discount, like that's all we have, then we want that discount to be more than that. And that's companies that have, let's see what else we own. So we own this. It's about a year old. It got reformed about a year ago. So the existing discount is higher than its average for the last year. It doesn't have the track record of having all this company data over the last 30 years. So it's just based on the last year. So it's currently more discounted than it's been on average over the last year. If we apply the same metric for the 3 years, it doesn't meet that metric. And if we apply the same metric for 6 months, it's close to being greater than that, but it's not. And on my end of things, at the 3-year mark, I'm still looking for a greater discount. Um, I'm trying to find, a fund, but this fund's been around about a year. So it has an amazing discount, but it's marked as single for two reasons. One, it's priced higher than our buy-in price, than our average buy-in price. And two, it's below the 1-year average. Uh, let's see what else. I got to put an asterisk back on that one. Um, this would be a 2 because its price is lower than what we currently have. So in that sense, it's a dollar cost average. But in the dividend strategy and the selection based on discount strategy, it doesn't meet the demands. Historical discount's about 8, so the discount would need to be at least 16. But on the 5-year pattern, it works. But what I'm looking for is both, because I want the best possible deal, the best possible investment of money. So it's CCIF. And I know this is kind of disjointed. It's not exactly my point, but so this discount as is higher than the 6-month discount, but it's not higher than the 3-year discount. And I would be willing to give a little grace. Like, so shorter history, we can't evaluate the discount of everything in existence compared to the distributions, right? But if we had all the data, we could look historically and guesstimate, kind of generate a average historical value and then see where that puts us now. But since we can't, if we look at just 3 years, you could argue that if the discount climbed to 10, it would be higher than the 3-year and it would be higher than the 6-month. That's a better time to invest than now when the discount is lower or smaller than those numbers. So on the seeking alpha side of things, it's like they're trying to look at from what I can read, which I can't, I don't read the paid for articles, but of what I can read, it's like they're treating closed end funds like a single stock entity or like a mutual fund. Mutual funds have tons of stuff inside, like closed end funds do, right? But the difference is the primary difference is closed end funds have a closed number of shares. You cannot just add more shares. And a mutual fund, like a single stock, can add shares whenever. So it seems like you're comparing apples to apples, but you're really kind of comparing apples to pineapples or apples to watermelons, like that apples to mangoes. Like it looks similar on face value. It has a ticker, it has a price, right? It has an overall worth, but you're not taking into account the discount. Maybe you are. It's like, hey, it's selling at a discount, but it's not taking into account the discount based on a historical outlook. So I'm not saying that it's bad advice. I am saying it's a very different strategy than mine, and it does not mesh with my strategy. So I don't pay for it. Now, if you're into single stocks and mutual funds and you want somebody else's advice, by all means pay for it. By all means sign up and see what they say. But so long as they put out stuff like this, I'm going to keep reviewing them and comparing our strategy and methodology because it's an easy way to polarize what we do compared to what somebody else does. And as I said, I pay for the contrarian outlook. Um, as much as I love what they advise and put out, they also say their strategy has changed interestingly in the last year or two, and they are not immune to getting some kind of critique on these videos. So I've done one already, and I got another interesting email with advice, and I'll be critiquing that email based on our strategy. So, um, and who knows? I mean, who knows? Maybe at some point somebody's like, this guy's offering crazy advice. Here's his advice. Here's my advice. And this is right. So like we all have an opinion. Uh, everybody's doing the work. Everybody's trying to do the best things for them, but also help somebody else. So I'm not going to outright slander anybody. I just want to, my whole point is that just because somebody gives you information and says it's a good deal, you need to do some thinking for yourself and see if it meshes with your strategy, if it meets your needs, and if it aligns with your goals. Um, yeah, I'll leave it there. So, I mean, there's not a ton else to say. I feel like I'm saying everything else again. So, if you like the content, consider subscribing to my channel, hit the like button, and then head over to Facebook and join my group there called Navigate Your Finances. And that information will be in the description. I used to post a link, but YouTube gets mad at that stuff now. So as you face the week, as you face the rest of this year, and as you look ahead into 2024, you are the captain of your ship. Your ship will go wherever you steer it. And if you're not steering it, then you're not exactly exerting your control over where your ship is going, right? But your ship will go wherever you steer it. And if you don't steer it, you're still actively choosing to steer it wherever the wind blows. So steer your ship where it needs to go. Wherever you're headed, wherever that is, which hopefully it's headed towards your dreams and accomplishing your dreams. And if you've never heard that, then go find me on Facebook and read my daily posts and sift through my advice and the files and everything else and see if it meshes with something you need. See if it makes sense. Right. But steer your ship toward your goals. Steer your ship toward your dreams so you can change those dreams into a reality. And of all the options along the way, like all the ports of call, all the detours, all the stuff that draws your attention. Don't listen to it. Take a break if you need to, right? Reassess when you need to. But everything that isn't the life you're hoping to create, ignore, because all it does is distract you and take your money. Think about that. If from wherever you are, if you're steering your ship to your dreams, right, that's where you want to be, then all the other distractions that are just wasting your time, say no to that. Now, I'm not saying not have fun. I'm not saying not be with your family. I'm not saying invest in yourself. I'm not saying that. But the phone, scrolling through TikTok videos, wasting your times, glued to a TV, um, all the stuff that just distracts us from purpose, right? Erect some boundaries and say no to all that stuff, right? And then steer your ship towards your dreams. And if you'll steer it there, right, and focus and work on things daily, right, the other distractions will not be as tempting as they are right now. Like if you're stressed, if I talk to most people, if I talk to most kids, what do you do? I scroll TikTok. Why? Because I get bored. What do you want to do? Well, I have these great dreams. Are you doing anything about it? Well, like I think about this stuff. Okay, but are you actually doing anything about it? Because that's different. And as I talk to people and I talk to kids, as I watch my own habits, we all get sucked into the distractions because that's the whole point. The distractions are distractions, right? So if you think of yourself like a ship, you think of your metaphorical vessel like a ship, and your dream is that X marks the spot, unknown island on the middle of the map, right? If you steer your ship towards your dream, all the different distractions, the ports of call, the crazy towns, right, where people go to have fun, depending on your revelry level of fun, but they go to have fun and they just seem to get stuck and lost there. They never really leave. They never make it farther in the journey, right? Say no to the distractions. Cut back on the distractions. Focus on you, focus on your journey, focus on where you want to be. And the more you streamline your actions, the more you streamline your thought, the more you face the day and face your dreams with purpose, all the distractions kind of gray out and they're not as distracting. They don't call to you anymore because you have a different focus. And you can recognize and say, like I'll scroll for 5 minutes and then it just kind of gets boring. And you're like, instead of just getting sucked into the scrolling of something that you're just like flicking your finger up and scrolling through TikTok, instead of doing that, you're like, man, I really feel I need to be doing this. And you'll put the phone down and do something else. Right. So captain your ship. Your ship will go wherever you steer it. So make sure you're knowing where you're going and why. And if you want to learn more about that, come find me on Facebook. So whatever you have for the week, whatever you have for the rest of the month, whatever your Christmas break looks like, whatever New Year looks like, and whatever you hope to accomplish and do in the next year, make it happen. Shock your world, change your life, change your life. Not the New Year's resolution, not the fleeting hopes that just kind of evaporate because there's no structure. Change your life, make a positive change and continue that. Make progress towards your dreams. Make them happen because they will not happen on their own. I mean, wherever you want to be, like if it could have happened, it would have already happened, but it hasn't. That just means you're going to have to actively do something about it. So, whatever your dreams are, whatever they are, if that's a different job, to live in a different area, to own property, whatever it is, make it happen because it will not happen on its own. Steer your ship. Steer your ship. And that ship will go wherever you tell it to go. Make your dreams happen. Make them a reality. And if you need help, ask. Comment on the video. Find me on Facebook. Let's get you going, right? And let's move from dream to reality. So this is Daniel Young signing off. I will see y'all on another video. Bye-bye.